Hey guys, Jason here. So I'm going to do a video that I'm going to post just for Leavitt Brothers members. I might do something similar, I don't know, later this week or next week and post it on YouTube, but for now this is a Leavitt Brothers video only. What I'm going to do is I'm going to do a series of videos where I talk about, where I'm going to compare the current situation to previous market tops just to see if there are any similarities, to see if we can grab any hints from the past that could act as guides for us now. Because right now we're in a situation where maybe a top is in place, maybe the market goes up one more time and makes a higher high and then a top's in place. We don't really know. But there are hints and clues out there, and I want to start covering them one by one. So in this video, I'm going to talk about new lows. I'm going to look at the 2008-2009 period and see how new lows acted there. Then I'm going to look at the 2015-2016 period, see how new lows acted there, and then I'm going to come to today and see what can we draw, what can we learn from previous tops to kind of use today to gauge whether, hey, is a top in place where we're going to get a big move down? Is a top in place that's going to be followed by sideways movement? We don't know. Let's be objective. Let's not force our opinions on the market. Let's just see if we could use past quant studies essentially to guide us today. Nothing is set in stone. There are no guarantees. The Fed could do something that throws the charts completely off. But generally speaking, quant studies, do have some validity. So let's check them out. Okay, so first what I'm going to do is look at, this is the 2007, 8, and 9 period. Okay, so you can see 7, 8, 9. So this is a 3-year chart. So the thing I want to point out is that when new lows expand unexpectedly, that often serves as a major warning that something is happening. Okay, so here's 2007. Prior to this, the market was doing really well, trending up, posting big gains. After all, it had bottomed in 2003, so it had been moving up for a couple of years. It had posted really big gains. And then what happens in 2007 is you get what would be considered a very minor pullback within an uptrend, but there is a noticeable uptick in new lows. Okay, and that was a warning. And this uptick in new lows, you can see over here, is 200. Okay, that was a warning. So then the market moves up. This is the S&P 500. It moves up to a higher high here. And then we get, again, what would be considered a very normal pullback within an uptrend where the market is, close to its high and well off its 52-week low. And what do we get? We get another big uptick in new lows. Market moves up from there, comes back down, and we get another new uptick in new lows. So what I've seen is that when the market is acting really well, when it's healthy, when it's strong, when it's trending up, if you get a noticeable uptick in new lows when during a very, very normal correction or pullback, that's a warning that something's going on. That's a warning that weakness is starting to build. Because why would so many stocks be that close to their 52-week lows? Okay, we're not talking about 1 month lows, 3 months lows, something like that. We're talking about 52-week lows. Why would so many stocks be so close to their 52-week lows that a relatively minor pullback causes so many of them to drop to a new low? Okay, then you can see what happened, obviously, in 2008, where the market fell and new lows started to expand. We got a move down here. We got another pop in new lows, which told you that weakness still existed. You got a sell-off here and an expansion in new lows, which tells us new lows. The new lows expanded, which tells you that weakness still existed. And then, of course, the market fell apart. Then if I come on the right side here, you get a dip here, which doesn't seem like much, and there's no expansion in new lows whatsoever. And then you get this area here, which it doesn't look like much, but that's almost a 10% drop that lasted about 6 weeks, and there's no expansion in new lows over here. Okay, so it was the expansion in new lows over here while the market was undergoing what would be considered a very normal pullback within an uptrend that told us weakness was starting to build, and it was the lack of new lows over here that told us we were probably home free, the worst was behind us, and we could get a little bit more aggressive to the upside. All right, let's move on to, this is going to be the 2015, 2016 area. Actually, this chart over here is mostly 2014, 2015, 2016, and it goes into 2017. Okay. So just as a refresher, 2012 was a good year. 2013 was a fantastic year. And then this year over here is 2014. So we got to move down here, and we got a big noticeable expansion in new lows. Market then moves up to a new high here, and then you get what would be considered a very minor pullback within an uptrend. This market makes a new high here and then just pulls back. And again, you get a very noticeable uptick in new lows. Couple more down, then we hit another new high here. Okay, couple moves down here, again, upticks in new lows. Okay, so even though the market is strong, it's healthy, it's trending up, we had just come off of, you don't see the left side of this chart here, but the market had been literally trending up for most of the time, going all the way back to late 2011. So we're talking about a several year uptrend where big gains were posted. Most stocks should be participating. So if the market pulls back a little bit, you shouldn't have that many stocks so close to their lows that a minor pullback causes them to hit a new low. So then the market enters this sideways range here. We have we have a new high followed by a very minor pullback, but there's another uptick in new lows. And then you come over here where you have, here's a pullback with an uptick in new lows. There's a pullback, uptick in new lows, and then just even like nothing's going on in here, and you still had an uptick in new lows, and then of course the market fell apart. So it was the uptick in new lows that told us, negative pressure was starting to build. So the market falls hard, comes back close to a new high over here. We have a pullback here and a pullback here, and guess what? Uptick in new lows that tells us that there's still negative pressure there and the market's not done going down, and of course then it falls. Then the market bounces. You get a pullback here, no uptick in new lows. You get a pretty harsh pullback there. You have one day here where you get 100, okay? But for the most part, you don't have an uptick in new lows. Nothing consistent, and certainly nothing, that's 100. Certainly nothing like the 200, 250s that were recorded over here. And then you have a little bit of an extended, 6-7 week pullback that goes, 5% or so. And again, no uptick in new lows. Okay. So uptick in new lows that told us negative pressure was building. And it was the lack of new lows over here that told us we're good to go. Now let's look at today. So here's today, going back to June of last year. So this is about a 18-month chart. So if you remember from the last two, an uptick in new lows is like 150, 200. So this here and this here I would not consider to be upticks because that's only like 40. It's not that big. So what we have here is market obviously strong, healthy, trending up, higher highs, higher lows, all that stuff. It's been a really, really good time to trade. And then what we had here, and you can see here we have a relatively minor pullback and no uptick in new lows, nothing noticeable. And then we have a brand new high, and then a very, very, what would be considered a very, very minor pullback within an uptrend. And then we definitely have an uptick in new lows here. Okay, so going forward, now the question is, what could we take from the last two tops? What can we learn from that and apply it to today to kind of set the stage for what we're looking for going forward? So what I'm looking at here is, let's assume the S&P is going to make a new high. Okay, it did well yesterday. It's following through today. It's got a 2% gain as I record this. It's probably going to make a new high. So if it makes a new high, and then at some point in time it's going to start doing some backing and filling, if new lows during this new high, new lows are probably going to fall off. But during this period, when the market actually pulls back, if new lows ramp up again, that tells us that we're not in the clear. We can't get aggressive to the upside. We can still play longs, but we got to keep stops tight. Just shoot for singles, not for home runs. But if during this period here, new lows just completely contract and are registering down here like 20, 30, 40, then that tells us we're probably in the clear. Okay, so that's how I'm going to be using this going forward. I'm assuming the market's going to make a new high here and I don't know how far it's going to push. Who knows? At some point in time, it's going to do some backing and filling, and during that correction, it could be a few days, it could be a week or so, maybe even a couple weeks. It could be high intensity, it could be low intensity. Whatever the case, during that pullback, if we get an expansion in new lows, that tells us weakness still is there and we can't get too aggressive to the upside. But if new lows completely fall off, I think we're in the clear to at least ride this thing into January, maybe even longer, and then we'll reevaluate at that point in time. All right, so hope you got something out of this. Obviously, we don't know the answers right now because we have to wait. We'll see if the market makes a new high, but at some point in time, it's going to pull back, and then we'll see. If we get a big uptick in new lows, that'll be very telling. If we don't get an uptick in new lows, that also will be really telling. All right, good luck. See you next time.